I'm Neil Shah, for now market strategist at Edison. For 20 years, I used to sort of run the research team. Market strategist means that actually over the last year, I've spent a lot of time looking at the themes driving the market, hence meeting people like Toby at Oberon who opened the conference, and actually speaking to companies about how they are sort of navigating the market. And I think we're going to, the second panel is really a flip of the first panel, which is other ways, effectively, of benefiting from the AI theme. The concept of Halo, if you're not familiar, was sort of coined in February. You hopefully remember the moment where sort of Anthropic released the legal services plugin, and it caused panic in the market on the software side. And today, when I talk to investors, there's still concerns about the long-term durability of these software stocks, the moat being eroded. And capital is actively being sort of deployed in more defensible areas. It wasn't me who coined the term Halo. It was actually a US wealth manager, and then it was Josh Brown, and then popularized actually by Goldman, who started running a screen. I will touch on how the screen works because it's relevant. What's it about? Well, if you think that AI is going to start eroding conventional business models, there are some businesses that are going to be defensible, and Halo really starts for heavy assets. So this concept that AI is not going to replace oil fields. It's not going to replace mineral resources. It's not going to replace, water infrastructure, and low obsolescence. And it's really important when you're looking at this theme that actually you keep that in mind, that is what you're testing. But there are other reasons for taking a look at it. It's not just that it's defensible. It's that actually in the world today, where you're seeing geopolitical fragmentation and onshoring of assets, there is growing demand for infrastructure assets. And if you believe that inflation is an issue and we're in a higher rate environment, actually you're getting rewarded for inflation-linked assets, and hopefully a couple of people here are going to talk about how their businesses sort of link to that. Year to date, actually, the Halo stocks have done very well. And if you think about the sort of construct of the screen on the heavy asset side, when I run a screen, I typically look at what proportion of the total assets is made up of those heavy assets, so plant and equipment. What is the capex to revenue ratio, and the inverse, how much of the balance sheet is actually made up of intangible stocks. And the obsolescence side of things, you have to take a look at the sector. So sector durability, depreciation over revenue is a good, and asset turnover, a couple of measures. And when I did run the screen for the FTSE 250, top of the list was Pennon. And I'm very grateful for Sarah to be for coming here to explain how Pennon is playing into the sort of Halo theme. But a company that didn't feature highly on the Halo screen was Supermarket Income REIT. Mike is here to talk about Supermarket Income REIT. And part of the reason for this is the way they account for what they do. But actually, I wanted to get him on to show that there is another way of looking at it, and the importance of actually focusing on the two components. How durable are your assets? The other side of it is that I'm a believer that AI is going to continue growing, that there is going to be demand for energy assets. And we've got two people on the E&P side to talk about the energy side. So I will bring up Colin from Zephyr Energy. And then Philip has kindly, standing in for Bambo, has taken a slight turn for the worse, but is okay, from Anando. What I will get them to do is sort of come up, introduce themselves briefly at the lectern, and then run through 5 to 7 minutes what their company is doing in the space and how they represent a play effectively on the Halo theme. Do you want to come up first, Sarah?
Thank you, Neil, and great to be here. Great to see such a packed house. I was chatting to Neil just beforehand. He was saying this is the third year of this conference, and the audience is growing, and I can see so. There's only a couple of seats empty. So very nice to be here indeed. I am the Chief Strategy and Regulatory Affairs Officer at Pennon Group. For those who don't know the company, we own a series of water companies across the southwest and the south of England. We're a FTSE 250 company. I like to think of us sitting near the top of the FTSE 250, have bounced around a little bit. We've got about just shy of a 6 billion regulatory capital value, for those of you who know a lot about regulated assets. But essentially, the regulated capital base is how you earn your return from the regulator. As I say, FTSE 250 listed, we've got 4,000 colleagues across our patches, delivering about 1 billion litres of water a day to 4.3 million customers. And the water industry in the UK touches about 26 million households. So really, really huge industry, sort of hidden in plain sight a lot of the time, it feels like. And this is an incredibly exciting time to be in UK water. And I'm looking out at the audience and I can see David Lloyd-Seed there. And as David knows, this is my second tour of duty in the water sector. I was working with the industry back in AMP6, so from 2015 to 2020. And David was my counterpart at the beginning at Severn Trent, where I was the head of IR and strategy at Pennon, and he was head of IR at Severn Trent, so good to see him there. But one of the reasons I've come back to the industry after a long spell in financial services is because it is such an exciting time. We are very much at the cusp of a water investment supercycle. This AMP, so regulatory capital cycles, work in 5 years at the moment, have done for a long time, and there's some view to potentially extending them out a bit so we can get more long-term planning, which is great. But essentially, this sector is doubling in size this 5 years, from 2025 to 2030. And I don't know about you, but I can't point to many other sectors in the UK that are growing at that rate. So that means that we're investing 104 billion across the sector over the next 5 years in the asset base, obviously looking to deliver a step change in environmental and customer outcomes. But it's the most capital-intensive phase of this industry's existence. And as many of you will know, the industry was privatised about 30 years ago, and it's dealing with a lot of politics and reputational issues at the moment. I'm sure you've seen many column inches and headlines that we're dealing with. But underneath it is a very exciting, very impressive investment case, I think. We're dealing with water resource pressures, so population growth, the EA looking to reduce abstraction to help environmental outcomes, climate change, a deficit of 5 billion litres of water by 2050 if we don't take action now. Continued environmental improvement. Many of you have seen that we're under pressure with public expectation that we'll improve environmental performance, which we absolutely should, and so we're investing in that. Asset health and the condition of infrastructure as we're looking to grow, as we're looking to develop. Obviously, we need to look at the asset health, and that requires additional investment. And then you've got emerging risks, and some of you may have seen the debates around things like PFAS, these forever chemicals that you find in soil, obviously make their way into the watercourses, and we have to manage those. So I think the challenge now is not about identifying the need for investment, but it's about ensuring the system can deliver it. And what this shows, I think, is that there's a need for real focus from a political sort of policy and regulatory standpoint. And for those of you that do follow the sector or have been aware of the water reform agenda that's been running through the course of the last sort of 18 months or so, Sir John Cunliffe has written a very comprehensive report that came out last summer about the state of the water sector and the need to move to more of a water systems approach. And that sort of lays the groundwork for a new regulatory framework going forward. And that obviously will underpin future investment and the investment case of the sector. As with all things to do with policy and government, for those of us that have worked in and around it for a long time, it's not moving quite at the pace we'd hoped, but it is progressing. We're expecting to see a water bill come through towards the end of the year. We've had a white paper, we've got a transition plan in the offing from government, and this is about laying the foundations, as I say, for a future regulatory framework which will enable this massive scale of investment that's required. So for decades, I think you'll probably all agree with me that water's been treated a bit like background infrastructure. You know, we expect to wake up in the morning, turn the taps on, have the shower, do whatever we want to do with water, walk out the house and not worry about it for, you know, about £1.86 a day. Bargain, I'd say. So we, you know, it's been sort of largely taken for granted, and the only time we really see it making the headlines is when something's gone wrong or suddenly something doesn't work as expected and we all focus on it. But we have entered a period where I think water is moving into a new phase, and the reason that we're here today is it's become economically strategic. So we can't deliver the government's growth ambitions around 1.5 million homes. We can't deliver the energy transition or AI infrastructure or even environmental recovery without water. And people are really starting to switch onto this. It's one reason why obviously the capital programme is so large at the moment. But as I say, I see it as a super cycle. And if you look at all the estimates within the companies in the sector that DEFRA is looking at, we only see CapEx continuing to grow out for the next 10, 20 years, maybe longer. So that's why, for me, I think water really does belong in Halo. I'll confess that, as I think I mentioned to Neil, I only heard the term Halo a couple of months ago as investors started to come up to me and say, hey, what do you think about this theme? And I looked it up and saw what Neil's said today, which is obviously it's a very clever term coined by Goldman Sachs that we should all adopt. But as an investment theme, I think it makes perfect sense, and it's very clear why water should sit within that. Not as an ESG adjacency, which is where we've sat for some time, but as a foundational resilience infrastructure on which everything is really built. So moving from this utility to this growth enabler is a key reason why we fit within this theme. And with ESG moving more from, you know, checking, seeing as a sort of almost a compliance measure and a hygiene factor to something that is clearly critical for resilience and the future of the UK. I mean, just in the last year, for example, we had the drought in 2022, and there's lots of talk of potential drought in future. We all know that, but I mean, just over the last financial year, we've dealt with 8 named storms. And so it's the frequency and the cadence of extreme weather events that's challenging us in our infrastructure environment and many others as well. And moving from this idea of an asset base, which is obviously what the sector's been founded on, to the idea of a water system. And that's one of the things that was very clearly stated in Cunliffe's report, which we absolutely support, is this idea that we need to look at the system as a whole, not just the water sector. There are many, many stakeholders involved in the water system, and we have a key role in convening those and having statutory responsibilities around that. And then, you know, also just the way that the framework's moving, sort of moving more towards this idea of regional planning. So thinking about catchments, you know, where does water fall, how does it flow? Hydraulic modelling, for those of us in the industry, is something we're all very focused on at the moment. You know, how does water move from A to B? How do we best capture it? Where should we build the assets of the future? And that involves thinking about digital optimization. So whilst we're not a business I believe will be disrupted by AI, we're certainly a business that needs to adopt AI. And that is something that we as a business and as an industry are very focused on, building more intelligent systems that will help us to better predict and forecast and manage our infrastructure going forward. So I've talked a lot, I'm sure I've used up my time, but I think as a sort of punchline, if you like, I think investors, and I hope you'll all agree, are increasingly recognizing that this is an investment super cycle, and what we're seeing is that water is moving from being viewed as just a regulated utility to a major national critical infrastructure play. I'm very excited to be part of it.
Thank you, Sarah. And Sarah's, if I just, typically when you run the Halo screen, you would expect conventional utilities to show up, and Pennon is a great example of a well-run business. What doesn't show up, which is why I thought it'd be good to give you a contrast, is, or it doesn't show up as well, But equally, I think it shows all the characteristics that you're looking at a Halo theme is, where we shop. Mike, come on up.
Great. Well, good morning, everybody. I am Mike Perkins. I'm the CFO at Supermarket Income REITs. I will do my best to keep this concise. We do what we say on the tin. We are the largest landlord of grocery supermarkets in the UK. So if I just start with kind of who we are, just a brief intro. We are a FTSE 250 supermarket specialists. We are the only pure play investor in grocery real estate on the London Stock Exchange. We have a market capitalisation of £1 billion. Our dividend yield today, which is important for our kind of income-focused investors, is 7.5%. And we recently announced an uplift in our dividend to a minimum 2% uplift from FY27 onwards. We are an investment-grade counterparty. We have a BBB plus credit rating from Fitch. And those of you familiar with the business, we went through an internalisation early last year, and the material cost savings there have delivered an EPRA cost ratio, which is effectively your costs plus your admin costs as a percentage of your revenue, of 9.2%, which ranks only second behind London Metric, so amongst the sector leaders. And our discount 20A, although it's moving around with volatility at the moment, is at 6%, but again, one of the tightest discounts in the sector. So just moving to our portfolio, we have a high-quality portfolio let to the leading supermarket operators. We have 128 supermarket assets with a combined portfolio value of £2 billion. And we have predominantly long-dated, index-linked and triple-net leases. So you can see the 12 years of WALT and 82% index-linked leases provides a really high visibility of our future cash flows, and we have 100% occupancy in the portfolio. You can see we set out two maps. We are invested across the UK and more recently in France. Our assets are well diversified across both regions, and we have our rent roll is largely backed by the largest grocers. You can see Tesco and Sainsbury's making up the lion's share of our rent roll, and together Tesco, Sainsbury's and Carrefour represent 75% of our income, so that investment grade backed income underpinning the returns to the portfolio. So if I start by taking you through a typical example of an asset in our portfolio, what we've shown here is our Tesco store in Thetford. This is a large format store. It's about 80,000 square feet. It sits on a site that comprises 13 acres and has over 500 car parking spaces, and the store itself will employ approximately 350 people. But what you can also see from this map, and the reason why we like this asset class, is that proximity to the catchment area, and you can see 5,000 new homes under construction, which means that the catchment is actively growing, and that for us will drive long-term sales in the store and ultimately be enhancing to our rental growth perspectives. And this is an omni-channel store, and it serves as effectively a last-mile fulfillment hub. It has 13 home delivery vans, and with grocery, the key is that proximity to your consumer and being within a 10-minute drive time radius. So this site is ideal for us, and if you zoom this out further, you wouldn't see another Tesco's or Sainsbury's with another 15 minutes drive time. So it's the dominant store in that catchment area. So this is just zooming in to give you a bit more of an asset profile. You can see this store provides the full omni-channel service, and what we mean by omni-channel is that it provides in-store, click and collect and home delivery, so that virtuous cycle. This store will do around £70 million of annual revenue. So these are large businesses on their own. They are almost FTSE 250 businesses in their own rights. They are very large business units. Grocery is all about scale. The more scale you have, the greater pricing power you have. So you can see we've broken down on the right just typically how those sales are broken down between the sort of in-store, approximately 70%. 20% will be across fulfilled through online, be it through click and collect or home delivery, and about 10% through petrol sales. But the omni-channel nature provides that structural obsolescence protection for us. And then the scarcity of supply, which we'll come on to, equally reinforces the criticality of these assets, which is why when we're underwriting our assets, this is all the characteristics we look for that's inherent within our portfolio. So why is this model so durable and why is it so difficult to disrupt? What we've set out on the left of this slide is Tesco's online omnichannel distribution map. The blue dots representing the omnichannel stores and the green dots being the regional distribution centres. So you can clearly see from this map the density of their UK grocery network. They have around 20 regional distribution centres and around 800 large format stores. And those stores serve approximately over 80% of the online grocery orders, and they're fulfilled through our stores. So that's what makes these store networks and supply chains so irreplaceable in that regard. But what we have seen is that this presents a very high barrier to entry for new entrants, and it's very difficult to disrupt. And what we have set out in the middle here is some of the more recent failed disruptors. There is a recent trend towards rapid fulfillment capabilities. And where these have fundamentally failed is that they are capex intensive, they have long payback periods, and they've effectively tried to build out their own dark store network and supply chains. And as I said, ultimately very hard to deliver, given that kind of the unit economics don't really stack up yet in that kind of, unless you're in and around London. In contrast, what you see on the right-hand side of the screen is the omnichannel grocers are able to respond to this competition, introducing their own rapid fulfillment at a low cost through their own store network. And that is really illustrated on that map where, as I said earlier, grocery is about proximity to your customers, and the store networks are best placed to fulfill that online delivery. So our tenants are some of the leading and largest grocery operators. They are all consumer-facing businesses. They have very public sustainability guidelines and targets, and that means they're investing their money in our stores. We've shown on the left there the annual capex expenditure for both Sainsbury's and Tesco's, over £2 billion annually. Now, clearly, there will be competing demands on that capital, so it won't just be in investing in the store network. There'll be share buybacks or other areas in the business where that capital will be put to work, but they are spending money on our stores. And for us, we are predominantly, as I said earlier, triple net lease business, and what that means to people, for those unfamiliar, is that once a tenant takes occupation under a lease, they're responsible for the insurance, the rates, and also the maintenance throughout the duration of the lease. So they're spending their money on our stores, and what we've shown on the right-hand side is just a couple of examples from our portfolio. I'll focus on the one on the right there, which is Tesco in Bristol, where Tesco made a multi-million-pound investment into the store for a new heating pump technology. And what that did for us, two things. One, it showed, firstly, the EPC went from a C to a B, so in line with MEES guidelines. But if you're, importantly for us, 7 years left to expiry, if your tenant is making a multi-million-pound investment into your store with a short expiry left on the lease, it gives you a view of their commitment to that store and the critical nature of that store to their operations. And indeed, what we were able to achieve with that particular site is, in early last year, we renewed that lease to a new 15-year lease off the back of post that investment in the building. So it gives you an understanding of how the grocers think about these sites as large kind of business units. So if I kind of quickly summarise kind of why we believe Super's investment case is as compelling as it is that we have a defensive and resilient sector through economic cycles. Grocery is a non-discretionary spend. You'll see consumers move up and down the quality curve in terms of move from premium to own brands, but fundamentally everyone needs to eat, so it's non-discretionary. We focus on strong tenant counterparties with best-in-class operators. 75% of our rent roll is backed by investment-grade covenants, so it gives us that security over our income. These are mission-critical infrastructure with high barriers to entry. We don't see AI as a disruptor to the business. We think it will make the stores more efficient, and attractive fundamentals in that zero capex and zero vacancy. Now that zero capex is where we screen poorly on the halo, but for me as an owner of these real estate, if I don't have to spend a penny on my assets and it's my occupier that's making the investment, well, that's just a win-win for me, because you're getting that longevity of the asset and the investment in the asset, but that's coming from the operators and not through our own capital investment. And we have secure long income, as we said, backed by that non-discretionary spending. So that is it from me. I'll hand you back to Neil, but thank you.
And I'm delighted you explained what triple net leases are rather than me having to do it. The other side of, so I think if you believe that there is going to be demand, AI demand going forwards, and we continue to see the sort of investment taking place, along with water and other, it's going to generate its own demand. Now, it's going to be demand for water assets, etc. But energy is an absolutely critical component on it, and two very different energy stories to come. So first off, Colin fortunately made his flight over from the US and is here to talk to us about what Zephyr Energy is doing in the US.
Thanks, Neil, and thanks everybody for attending today. It seems to be the year of the acronym, at least over in the States, with the taco trade, which I'm sure everybody's familiar with, the nacho, not a chance Hormuz opens. And now, when given the opportunity to talk about Halo, I certainly wanted to jump at it. So thanks for having me. So I am CEO of Zephyr Energy PLC. We're an AIM-listed company on the far end of the spectrum from you all. When I came into the company, we were about a $2 million market cap. We've grown that to just under 100 million today. We've done that in two phases. We've got a two-pronged structure. If you think of our business like a building, the foundation of it is non-op assets, cash-flowing assets, interests in about 600 wells, where we're not the operator, but we participate in the economics, and that's largely oil-focused. So that's the area in blue there on the screen. Then on the green side is the Paradox Basin. We have a 46,000-acre position that is operated. It was really an overlooked basin. When you saw shale play, modern drilling, modern completions come through, the Paradox didn't really receive any of that initially. So we are the first players who have gone in and done horizontal wells, modern completions, and had some really phenomenal results. That's largely a gas play. And it's interesting to note here, when you look at the map, the Rocky Mountains obviously run from Mexico to Canada, right through the middle of that area. You don't have a lot of pipeline capacity for gas that goes east to west. So we're positioned on the western side of the Rockies in an area where there's a huge amount of AI development, hyperscale centers going in. Just this month, to the north of us in the state of Utah, there's been an announcement for a hyperscale data center that will use 9 gigawatts of power. And to put that in context, I mean, it's staggering. The whole state of Utah only uses about 4. London on a peak day might use under 7. So it's a staggering. It's a 62 square mile development. So a lot of need for gas. That's the only way to fulfill the power requirements in this area, and we're really well positioned in terms of our location to supply that. We are a UK-listed company, but a lot of support in the States. We kicked this off with a Department of Energy grant from the US government. We've worked with both Democratic administrations and Republican administrations. It was hugely helpful. We had the first modern 3D seismic shoot in the area, but by using DOE grant funds, which is non-dilutive capital, we were able to tie the rock and understand that there were mobile hydrocarbons here which allowed us to really verify our seismic and give us the confidence to move forward. We've got a partnership with the University of Utah's Energy and Geosciences Institute. They've been a wonderful partner, really add a lot of horsepower from the analytical side. Certainly, there's a lot of AI in our business. It helps you do everything from pick well locations to come up with efficient completion techniques, but you can never replace the actual land position, the pipelines, the drilling operations. We're well funded through a combination of bank debt with North Dakota's oldest bank. We've got a non-op partner who's invested in our most recent well, and we have a $100 million partnership with a private equity firm to build up our non-op business. We are looking for additional partners in the Paradox, so we're looking at both farm-in partners and marketing partners for our gas. Again, this is not something you can replicate easily. The location is phenomenal. We've got 46,000 acres of leases. We've got a pipeline system we've bought that would take tens of millions of dollars to replicate. And we certainly think that not only is the geography exceptional here in terms of being close to the power demand and the greater growth in the AI side, but we also serve the West Coast markets, either running up to the Pacific Northwest or also down into Southern California. And lastly, just to go through what we've discovered so far, we've drilled 2 wells, the first 2 horizontal wells with modern completions. We have a resource base of about 74 million barrels of oil, just under our federal unit. It's a brand new federal unit. We've got a good export route. As I said, it's largely gas, but there are barrels of condensate that come out with it, which is trades in general to a premium to WTI. So really nice economics. We've discovered the right way to develop this. We're tying in our existing wells now, and we will be going and working hard to generate significant cash flow and growth from this resource base.
And last and certainly not least, I mean, I think, as I grew up, oil was almost synonymous with Nigeria, and we're very pleased to have Philip represent Oando Energy here today. A story that maybe a lot of people in this audience might not be familiar, but it's a really interesting story. Perhaps you can come up and run through the energy story for Oando.
Thank you, Neil, and good morning, everyone. And thank you, Edison, for inviting us to this very well-organized conference in what is the superb location, I think everybody would agree. Halo, Sarah said she didn't know what it was until a couple of months ago. I didn't know what it was until about 24 hours ago when Bambo dropped out and said, hey, you go and do this, and got some notes from Tony, and then scurried onto the internet to find out what Halo was. Anyway, I concluded that Oando is certainly a Halo business. You pronounce it Halo or Halo? Halo business, so it certainly is. Yeah. So, yeah, that's not me. That was Bambo, who was supposed to be here. Hopefully he's in and out of hospital overnight. So I, by and large, report to Bambo. I'm too old to have a job, so they call me an advisor. But I basically deal with the upstream assets that Oando has offshore. So Oando is a Nigerian listed company, Nigerian registered company. It's listed in Lagos and a secondary listing in Johannesburg. It's got the market cap in Naira there. Those who are quick will know that's about £300 million market cap. We've got 4 business streams. The upstream business is the prime one. And as you see, we've got a tremendous number of Halo assets there. We've got 26 producing fields. There's something like 90 reservoirs that we have in the portfolio. We've got an export terminal, over 1,000 kilometers of pipeline, 14 flow stations, an independent power plant from which we use for our own gas, and 2 billion cubic feet of gas processing capacity. So there's a lot of infrastructure there that's on the ground. There's accessing nearly 1 billion barrels of oil equivalent reserves. About 40% of that's liquid, 60% gas. Our production's a little bit lighter in oil. We took over most of these reserves from, first of all, ConocoPhillips in 2014, and then 2 years ago, another 20% from ENI. ENI were highly interested in the gas because they're invested in the gas liquefaction project. We are interested in the oil, so we're trying to tip the balance more towards the oil and away from the gas. Our other main business is our trading business. We've got credit lines of about $300 million and use that to trade something like 29 million barrels of oil and product a year. The offices for that are in Nigeria. Also, we've got an office in the UK and Dubai and South Africa. Then our 2 emerging businesses are clean energy and mining. We've got half a dozen different streams there. We'll be selecting from those and concentrating on them. But we've got an electric bus project running in Lagos, which is attempting to redress the carbon problem, and then wind and solar and so on. So we're doing research into those and see if we can find a spot in those. And as well as oil, actually, Nigeria is extremely rich in minerals, especially the north and central part of Nigeria. Very neglected sector by the government in the past. It's now woken up, and there are massive opportunities for minerals there. So we have acquired some licenses and are doing the exploration drilling into those. So concentrating on our E&P portfolio, our main assets are these onshore assets here, the OML 60 series, which is where most of the infrastructure is. But we also do have some blocks offshore. I think it's important to emphasize that, from a Halo point of view, we've got all those pipelines and the gathering stations. If you wanted to replace those, that would be offshore in deep water. And there you're talking about forking out, you've got to find the oil in the first place with $100 million oil wells. And B, you've got to fund the development schemes, and you're talking $10 billion to $15 billion budgets. So with these assets, we don't have that. They're sitting over a lot of underutilized reserves. We're only producing something like 1% of our reserves a year, so we can obviously lift that. And the capital we spend is not really capital investment in the same sense as a deep water offshore development is. It's really kind of what I would call maintenance capital. So it's doing reworking the wells, drilling a few new wells, and building the production. So we aim to go from our existing 40,000 barrels a day up to 100,000 barrels a day by 2030. We do have the deep water assets. Our philosophy there is to acquire them cheaply for no signature bonus or little signature bonus, and then to use other people's money to explore by farm outs. And so we don't throw too much capital into those, but hope to land up with a nice position at the end of the exploration and appraisal campaign of maybe 10, 20, 25% interest. So what we have is a very good block here, OML 131. We got control over it back in 2014. It's got neighbors that haven't been that interested. The Nigerian government 2 years ago brought in a new act that completely reformed the industry, the Petroleum Industries Act, and they added they reduced the taxation for these offshore assets, and indeed, only a year ago, the president brought in some new incentives as well. So actually, traditionally, the fiscal regime has been very tough in Nigeria, but now it's been eased up a lot, and it's now quite attractive to invest not only in the multi-billion barrel fields that are on production, but also in these smaller fields. So in OML 131, we've already got 100 million barrels discovered. They are adjacent to another 150 million in the next door block. The challenge is to cooperate with the neighbours and to cooperate with the government and get this on production. And we've actually come up now with a way of doing it. There are fields on production here in this block. And we're talking, actually, I missed the meeting actually to come here. We're talking with the neighbouring company that we move the oil into their facility. They've got a massive floating production system there that we can tap into. And it's a matter of doing clever commercial deals rather than spending massive capital. Likewise, we've got a 21% interest in this block. That's got 250 million already discovered. A massive upside to the side of the discovery and below, which needs exploiting with modern-day seismic. That is what we intend to get on with there. We had an interest in these blocks, OPL 321323. We still have a claim on those. They are probably the two best unexplored blocks in Nigeria, if not in the world. We're in Sao Tome and Principe, block 5 here. There's been a discovery of oil. It was uncommercial, but it proved the petroleum system in Sao Tome, and that was only a couple of years ago. And then last year, there was a well here, again, proved the petroleum system's working. We've got an excellent prospect there. We're very certain of the sands. It's just making sure that the structure works. And again, our philosophy is not to bear the capital expenditure totally ourselves. We might put a little bit of capital into that one. And the map designer couldn't actually fit Angola on here. So down in south of Nigeria, we've just entered a block onshore in the Kwanza Basin, which we operate. And that's our first operation outside Nigeria. So this is a zoom in to all the infrastructure we've been talking about. Here's all our Halo infrastructure. Those are the oil production facilities and the pipelines. As I say, there's about 1,250 kilometre of pipeline there. And again, on the gas side, which we know our reserves are 60% on gas, and that's the structure we have there. So this is showing our production growth. They've actually backed in pre the takeover of ENI. Oil is in here as well, so it actually went up in terms of investors because it increased here at this point. But this is giving you the underlying performance of the reserves. And you see that since we took over a couple of years ago, we've been pushing up the production, and we've been doing that not by heavy investment in infrastructure, but working the wells hard, and that's where we're spending the money. So we get payback pretty much immediately. The money goes into the workovers, or in some cases a new well or two, and we've got production immediately because we've already got the pipelines there. So we've got very fast payback. There's the production increase, and that's actually just showing you the effects of the acquisition where we doubled up on the reserves a couple of years ago. And yep, that's me then. Thank you very much. Neil.
Happy to take some questions, and while hands go up, I might kick off with one, which is, I think Halo's been AI has been to a certain extent characterized as the villain in this story, which is it's driving people to defensible business models. But if you think about the car 20 years ago and how many chips were in that car, and the car today, it feels like there is going to be significant demand created out of AI. And I'm just curious as to whether you've seen either any actual signs of that demand, or at least conversations pertaining to that demand in terms of getting your businesses ready. If I could start with Sarah and walk across the panel.
Do you mean as like a client? So
yeah, are you having conversations and readying yourself for growth and demand, I guess?
It's a really good question. So I think others in the sector are a lot further on. So if you're a water company in the southeast, our new CEO's just come from Affinity. I know at one point he was citing 81 data centres in. If you think Affinity is a much smaller water company than Pennon Group. And so, the idea that you could service 81 data centres from current supplies is not possible. So I think in the southeast it's a really big question, and one of the interesting things about the regulatory framework we're managing this AMP, which is positive, is there's a bit more flexibility in it. So we obviously did our business plans back in 2024, PR24, so we got our final determinations and we started them in 2025. But this AMP, we've also got the opportunity to ask for further investment in certain categories. And one of the categories that we're able to go back and ask for a bit more investment into is growth.
Yeah.
So I think it's a smaller, it's not such a big issue for us in the southwest. If you think about our regional economy, so a little bit maybe around Bristol, a little bit around our southeast Surrey business. But not so much Devon and Cornwall, which is obviously more tourism and agri-tech, etc. But also, I think, so it's something we're all sort of looking at, but is a massive issue for the southeast. And Ofwat's very focused on that. And that's also why, in addition to the enormous capital programme that we've all signed off for this time round, there's also 50 billion of strategic resource projects that have been identified by Ofwat, which are all designed to focus on the need to increase supplies. And then I think just, thinking of us, like flipping it, we are looking at AI within our own business, which I think, many companies are, not just water, but, for example, just getting much more smart. I mentioned intelligent water systems. So we've put 12,000 sensors into our sewers now. We call them our 12,000 eyes. And that's about us trying to make the network more smart so that we can focus and work through how it runs more efficiently, but also where we need to target investment.
Thank you, Sarah. And Mike, I think you alluded to it in your presentation, which is supermarkets are deploying it. We're going to end up tempted to buy more or deliver things more efficiently. Are you seeing any impact from AI in terms of your end client base?
Yeah, I think the way we look at it is probably through two lenses. We look at it through how can AI disrupt our business model, and I think we showed in the slides we went through is that fundamentally you can't replicate the store network, you can't get the planning, you can't find the acreage. So we think fundamentally from a disruption perspective, the store network is best placed to capture that growth in online spend. But then we look at it through kind of when we have discussions with operators. We're Tesco's largest landlord, we're Sainsbury's second largest landlord. And you'll see kind of, whilst we don't directly benefit from the investment our supermarkets are making in the AI, recently Sainsbury's And their reporting account showed that they'll look at the customer experience, how they can use AI to impact pricing, look at supply chain forecasting, and store optimization. Now, if you take one example where they're looking at pricing, is that they've now got AI can run 56 billion scenarios using real-time data to help price optimization in respect of expiring goods. So that, for us as a landlord, whilst we don't directly benefit, it should help store-level profitability, should help operating margins. And in our sector, our rents are generally based on store-level profitability or turnover, to oversimplify it. So the more revenue going through our stores and the better margins our stores can deliver is only good for us as a landlord if we look to capture rental growth in future years.
Thank you, Mike. And Colin, I think you also alluded to the fact that, you've got to, where the data centres are, your prime position. Are you seeing real conversations around that today?
Oh, 100%, absolutely. I mean, when you think about the regulatory environment in the States and where we're positioned, which is plentiful land, good resource, but really all of these data centers, the only way that we're going to meet the power demands for them is through natural gas. And operators are getting well ahead of that right now. So while I would say the construction cycle is certainly happening, and when you look at the number of centers that are planned, it's so I was saying before, pretty mind-boggling. So we think we see it all the time from end users and purchasers of the gas who are trying to lock in long-term contracts. We think we'll be the beneficiary of that for a long time to come.
Right. And finally, Philip, are you seeing anything today, or is it anticipation of future demand?
Sorry, give me the question again.
Are you seeing any from demand, effectively, growth in demand, or preparing for future energy demand increasing? Is it tangible, or is it?
Yeah, because AI is contributing to big increase in demand, just as we've heard. So that means that although the new energies are coming in and growing quite rapidly, it turns out that they're actually only meeting the increase in demand. They're not actually touching the baseload demand for energy. And, our oil fields and gas fields decline, and it's a lot. It's something like 20% a year.
Yeah.
All these big fields are declining, and there has been a lack of capital investment in those fields. So the industry's got to do a lot to actually keep up with the baseload. So obviously we see AI as essentially a customer, and not a threat. And then on top of that, AI gives us the ability to work a heck of a lot more efficiently. I mean, Orlando has an internal campaign that every employee should be using AI on top of AI. So we can use AI to make our production facilities more efficient, much more reliable. In Nigeria, we've got the special case of theft from pipelines, which is, one of the ways we can increase or decrease our operating costs is to eliminate theft. And we can use AI to do that because we use it, got drones up in the sky, and we can use it to see when there are odd people approaching our pipelines, and can alert the security forces to intervene. So yeah, it's a big, can't see AI as a threat personally. I see it as a customer and a way of making our people and our plant much more efficient. So yeah.
Thank you, Phil. Can I take any questions? One at the back.
Well, thank you all for a very good presentation. Lots of things to mull over. I don't know whether our esteemed Prime Minister is still in office, because I've not looked for the last hour. However, overnight I was noting, this particularly for Sarah, if I may, at least 3 of the 4 potential successors, as they see it, are very keen on more nationalisation. They've all mentioned they want to renationalise the whole of the water industry. I wonder if you might be able to give us any ideas how Pennon presumably are preparing to defend their corner, and whether you feel what the cost of renationalising again the water industry will be.
I'm delighted you got regulatory affairs in your title.
Yes, it's a great question, and it's one of the things I think I touched in my remarks on the politics of water, which is ever present. And although obviously it sort of comes to the fore as it is now, the reality is that I was dealing with this back in 2017 when I was last working at Pennon during if you remember Jeremy Corbyn's manifesto, which talked about nationalisation. So I think it's something that is always part of the conversation, this debate about private-public ownership. The reality is, certainly in this current incarnation of government, they've had every opportunity to look at nationalisation of companies like Thames, and they've not wanted to do it. And one of the reasons is obviously the cost. So there have been lots of estimates done, some of them by the industry and some of them independently. But I mean, if you think the sector's worth about 100 billion of RCV today, wouldn't be less, would it? So the cost is quite enormous. And then also, I think one of the hardest things for government, it's an easy thing to say, and it's very political. But in reality, as soon as you nationalise a business like this, every single pollution is the government's fault. Every supply interruption is the government's fault. Every bill increase is the government's fault. And I think most of us would recognise that if you tried to put water in the queue on the public purse behind what social care, education, the NHS, it wouldn't get a look in, and that was the whole rationale for privatising the industry in the first place. So I think we can't be complacent. It's always part of the patchwork, and it's always part of the politics of water, and we have to be very alive to that. And it's definitely an industry that requires excellent stakeholder engagement and a good understanding of the politics, but also a bit of sanguine about what the reality is behind the words and the sort of opposition that would face. But I think the better challenge for us is really that we have to perform. So I think I mentioned, I think we've won the case for investment, right? There's many, many things we need to invest money into in the water sector. But what we need to show, the pressure is on us as an industry to show the delivery. So, if you look forward, one of the ways that you would measure, I think, the success of our industry going through a super cycle like the one we're going through is to see how sustainable the RCV growth is, because the RCV, that's a tracker of our investment into our assets. But we can't just look at assets, right? We have to look at outcomes. And this is one of the things the regulator's been very focused on in recent times, is that we can't just say we're adding some more money to the asset base and we're getting a nice return on that, thanks very much. We have to be able to show environmental and customer outcomes alongside. So we have to deliver performance improvement on an epic scale to match the capital investment we're making. So I think, in a nutshell, we've got to be very alive to it. We've got to be in those conversations. We've got to be making the case for privatised water. We can never stop doing that. But the way that we really prove our worth is by showing the performance improvement.
Thank you very much. And I don't want to be cast as a villain, so I am aware that the next panel is due to start, and I do need to wrap up. People are around if you do want to ask questions subsequently, but if I could, you've been a brilliant panel. Thank you very much. Thank you very much.